Good afternoon, Alex, here with Morgan for a midday check-in. We told you what to watch this morning. Let's see how it's playing out.
It is certainly playing out. And it is, let's just say, not following the script anyone expected.
Not at all. It is Friday, February 13th, 2026. And that Friday the 13th vibe feels, well, pretty appropriate for the strangeness we're seeing. We're recording at 12:50 p.m. Eastern, deep in the midday session.
Yeah, if you're a currency trader, you're having a very, very eventful Friday. If you're an equity index trader, you might be wondering if your screen is frozen.
It's a tale of two markets, for sure. So let's start with the setup. This morning, we laid out the regime very clearly. We saw the VIX hanging around 20.8, which signaled caution.
Right.
And we defined the whole environment as macro-driven, rate-sensitive.
And we should, give ourselves a little credit there. That macro-driven call was spot on. This hasn't been about earnings. It hasn't been about some geopolitical headline.
Not at all.
It has been, from top to bottom, a session completely defined by the market trying to digest these enormous and, frankly, contradictory data prints.
Absolutely. When we say macro-driven, this is what we mean. Individual company stories are just getting washed out by this huge economic wave. But here's the crazy part, and this is why we do this midday check-in. If you just glance at the major indices, you think nothing is happening.
It looks deceptively calm. Let's do a quick vibe check right now, 12:50 p.m. What are the screens telling us?
Okay, looking at futures, the S&P 500 futures are at 68.89. They are up, wait for it, 0.01%.
A rounding error? It's nothing.
It's effectively flat.
Yeah.
And the NQ, the NASDAQ futures, 24.921, flat, 0.00%. You'd be forgiven for thinking today's a total snooze fest.
But that would be a huge mistake. We used a phrase this morning, calm on the surface, paddling furiously underneath.
That is the perfect metaphor for today. Because while the indices are asleep, other asset classes are seeing, absolute violence.
Violence is the right word. We are seeing moves in the euro that just shouldn't be statistically possible in a single day. The yield curve is on the move. And the data itself, it's a puzzle with pieces from two different boxes.
One piece says boom, the other says bust, and they arrive at the exact same time.
Yeah.
So our mission for this deep dive is to unpack that puzzle. We'll start with the growth surprise, that monster GDP number at 10 a.m.
Then we have to get into the inflation twist, because that's the other side of the coin that's causing all this confusion.
From there, the rate decision, and then we have to spend serious time on the currency shock. The euro move is arguably the real story of the day.
And we'll wrap up with what the smart money seems to be doing and then set you up for the elephant in the room, that bizarre 11 p.m. unemployment print tonight.
11 p.m. on a Friday. We'll get to why that's got traders so spooked. But first, let's start with what should have been unambiguously good news. Section 1. The growth surprise.
The GDP print.
Yep. This morning, our number one catalyst to watch was the Q4 GDP growth rate year over year, dropped at 10 a.m. Eastern.
And the consensus expectation going in was for 3.4%. Now, let's be clear, 3.4% growth is a very healthy number.
It's a strong economy.
Right. The prior reading was 3.6%. So the story was supposed to be, okay, the economy is still strong, maybe cooling off just a tiny, tiny bit, but holding steady. That was the narrative.
And then 10 o'clock hit.
4.5%.
4.5%. That isn't a beat. That blows the doors off the estimate.
It's a massive deviation. To beat a GDP estimate by 1.1% is huge. This isn't a small company's earnings. This is the entire economic output of the country.
It implies the models are just completely wrong.
Totally. It means there is so much more activity, so much more spending and production happening than anyone was capturing. And it wasn't just the GDP number either.
Right. We also got the employment change for Q4.
Yep. Year over year, that came in at 0.7%, beating the estimate of 0.5. So more output, more jobs.
So the first and most obvious takeaway here, that whole recession narrative.
It's dead. It's buried. You cannot even say the word recession in the same breath as a 4.5% GDP print. The data is screaming expansion, strong expansion.
This brings us to that term we've heard so much about, no landing.
Exactly. Last year was all about the soft landing versus hard landing debate. But a soft landing means you're slowing down gently.
And this isn't slowing down.
This is not slowing down at all. This is the pilot pushing the throttle forward after you thought you were on final approach. This is a no landing scenario. The plane's going back up.
Okay, so this is the million-dollar question then. I think it's what everyone listening is asking. If the economy is on fire, growing at 4.5%, why aren't stocks ripping higher? Why are we flat?
That is the crucial question. And the answer goes right back to the regime we defined this morning.
Rate sensitive?
It's all about the rates. In a vacuum, sure, 4.5% growth is amazing for corporate earnings.
Right.
More sales, more profits, stocks should go up. It's simple.
But we don't live in a vacuum.
We live in a world with a central bank. And in the context of the last few years, good news has been bad news.
The idea that the Fed has to come in and take away the punch bowl.
Exactly. The Fed's job is to stop the economy from overheating. A 4.5% growth rate is, by almost any definition, overheating. It implies demand is running way ahead of supply.
Which usually means inflation comes back.
Right. So the normal Pavlovian response from the market to a number like this would be to panic sell. The thinking would be, oh no, the Fed is going to have to hike rates even more to cool this down.
And higher rates are poison for stocks, higher borrowing costs, lower valuations, the whole thing.
Correct. So normally you'd see yields spike and stocks tank on this number. But, and this is the huge but of the day, that's not what happened. The market didn't sell off.
Yeah. Sat there, froze.
It froze. And the reason why brings us to the second massive data drop. We got the growth, but we also got the inflation data. And it completely torpedoed that fear narrative.
All right, this is the conflict. Section 2, the inflation and rates twist. Let's set the scene. Same time, 10 a.m., we're also watching the inflation rate year over year.
And heading into the print, the market was actually pretty bearish on inflation. The consensus estimate was for 4.9%.
Which is very high, uncomfortably high.
And the prior number was 4.1%, so the expectation was for a reacceleration. The trend was supposed to be going in the wrong direction.
So the setup in everyone's mind was hot economy, rising inflation, the Fed is about to bring the hammer down. That was the big fear.
And then the actual number printed, 3.2%.
3.2, that's not just a miss. It's a spectacular miss to the downside. We were expecting 4.9, and we got 3.2.
To miss an inflation forecast by 1.7 percentage points is, I mean, it's momentous. It's unheard of. It's just that whatever price pressures we're building just evaporated.
So let's put the two pieces of the puzzle on the table. We have GDP growth exploding upwards to 4.5%.
And at the exact same moment, we have inflation collapsing downwards to 3.2%.
On paper, that is the absolute holy grail of economic data, isn't it?
It is. That's the textbook definition of Goldilocks. Not too hot, not too cold. It's high growth with low inflation. It's what every central banker on the planet dreams about.
It suggests a massive productivity boom. We can grow without stoking prices. It's perfect.
It sounds perfect.
So, why is the market looking at this holy grail and just shrugging? Why are we flat?
I think it comes down to one word: trust. Or rather, a complete lack of it.
Trust in the data. You think it's a bad print?
Not necessarily bad print, but trust in its sustainability.
Right.
When you get two numbers that diverge, that wildly growth screaming higher, inflation falling off a cliff, it can feel like a statistical anomaly.
It feels too good to be true.
Exactly. Investors are looking at this and thinking, okay, what's the catch? Is the data broken? Is there some lag effect we're not seeing? Is inflation going to come roaring back next month? So they're hesitant to go all in on this beautiful story.
True. They're frozen by disbelief.
Disbelief, and then you add the third data point from this morning, the interest rate decision.
Right. That dropped at 10:30 a.m., the February rate decision.
The expectation was for the rate to be held at 16%.
And just for context, a 16% nominal rate is incredibly high. This is part of that aggressive global tightening cycle we've been in.
And the actual decision came in at 15.5%.
A miss. They came in lower than expected, a 50 basis point surprise.
No, 15.5% is still a very restrictive rate. But the fact that it missed the estimate, the fact that it came in lower, it sends a signal. It suggests that maybe global central banks are seeing this disinflationary data and are starting to think about a pivot.
But the market reaction to that, again, was basically nothing.
Muted. And you see that in the internal rotation. Look at the factors. We said this morning to watch for factor rotation. Well, even with this incredible growth data, the market is not buying high beta growth stocks.
It's doing the opposite.
It's doing the opposite. There's a clear defensive bid. Minimum volatility is the winning factor today.
Can you just break down high beta for anyone who might not be familiar?
Sure. High beta stocks are the riskiest ones, the ones that move more than the overall market. Think, unprofitable tech startups, speculative growth names. If you think the economy is booming and money is easy, you buy high beta because they give you the most bang for your buck on the upside.
And today they're buying.
They're buying utilities, consumer staples, healthcare. They're buying the most boring, stable companies you can find. So even with 4.5% growth, the capital flows are telling you the market is playing defense.
Which confirms that lack of trust theory. The market just doesn't believe the Goldilocks story is real. It's suspicious.
It's waiting for the other shoe to drop. And if you look at the currency markets, that shoe might have just dropped with the force of a meteor.
Let's go there. Section 3. The currency shock. This is the true outlier. If you're only watching stocks today, you are missing the entire story.
The entire story. The biggest move on any screen, anywhere, is in the euro.
The 6E futures contract, which tracks the euro, is up 3.48%.
I really want to pause on that number, 3.5%. In the stock market, if a stock like Apple goes up 3.5%, that's a great day. But stocks are volatile. That's what they do.
Right.
In the world of foreign exchange, of major currencies, things move in hundredths of a percent. A 0.5% move is considered a very volatile day. A 1% move is front page news.
And we are at 3.5%. In a few hours.
A move of this magnitude in a single session for a G10 currency pair, like the euro dollar. It's a black swan type of event. It's a multi-standard deviation move that breaks risk models.
What on earth causes that?
Yeah.
How does a major currency move like a penny stock?
It's a combination of things. That massive inflation miss in the U.S. data is part of it. It weakens the dollar.
Okay, let's connect those dots. Why does lower U.S. inflation weaken the dollar?
Because it changes the interest rate outlook. If inflation is falling off a cliff, it means the Fed might cut interest rates sooner, or at least stop hiking. Lower future interest rates make an asset, in this case the dollar, less attractive to hold. So global money flows out of the dollar and into other things, like the euro.
So the dollar falls, the euro rises.
Yeah.
But 3.5% feels like more than just a reaction to one inflation print.
It is. A move like this vertical, suggests a massive short squeeze was triggered.
Meaning a lot of big players were betting against the euro.
A huge amount. Hedge funds, institutions, they were positioned for the euro to go down. They were short the euro. When the data hit and the euro started ticking up, suddenly all of those bets started losing a ton of money.
So they all have to buy euros at the exact same time to close their losing trades.
It's a panic, a stampede for the exit door. And that frantic buying is what pushes the price straight up like a rocket. That's what a 3.5% move looks like. It's a forced liquidation.
We told everyone to watch the DXY this morning, the dollar index.
And the DXY is getting crushed because the euro is the largest single component of that index. When the euro rips higher like this, the dollar index has to fall.
So let's make this real for our listener. If you're an investor, sitting in your office, why does a wild move in the euro matter for your stock portfolio?
It matters immensely because of corporate earnings. The S&P 500 isn't just a collection of American domestic companies. It's packed with global titans. Think about Apple, Microsoft, Procter & Gamble. They sell billions of dollars worth of goods and services in Europe.
And they get paid in euros for those sales.
Exactly. So if the euro suddenly becomes much stronger against the dollar, every single euro they earn is now worth more when they convert it back into dollars for their financial reports.
So it's an instant boost to their reported revenue and profit.
A huge boost. In theory, a weaker dollar like this is a form of financial easing. It should be very bullish for the S&P 500.
But the S&P is flat.
Because the market hates volatility. Even if the end result of the move is good for earnings, the speed, the sheer violence of the move is terrifying. When currencies move this fast, things break somewhere in the system.
Derivatives, hedges.
All of it. Hedges blow up, risk models fail, CFOs start to panic. The market hates that kind of uncertainty more than it loves the potential earnings boost.
It's a classic case of the cure is worse than the disease, at least in the short term.
For now, yes. Now let's look at another asset that should be reacting to this. Commodities. Crude oil.
Okay, so the rule of thumb is that oil and the dollar are inversely correlated. It's a seesaw.
Right. When the dollar goes down, which it is, oil should go up. It's priced in dollars globally, so a weaker dollar makes it cheaper for everyone else to buy.
So with the dollar getting hammered today, oil should be fine.
It should be. But look at the screen. Crude oil is trading at 62.67. It's up 0.05%. It's flat.
It has not budged.
That is a massive divergence. Crude oil is completely ignoring the currency move.
What is that telling us?
It's telling us the underlying demand signal for oil is incredibly weak. Despite that 4.5% GDP growth number, which should imply a lot of economic activity.
Trucks driving, planes flying.
All of it. And despite the crashing dollar making oil cheaper, traders are still not buying it.
That seems like a major contradiction. The GDP data says the economy is booming, but the oil market says, nope.
It's a huge contradiction. And it suggests one of two things. Either the oil market simply doesn't believe the GDP number is real or sustainable, or the growth we're seeing is coming from sectors of the economy that don't consume a lot of energy. Think software, services, artificial intelligence.
A digital boom, not an industrial boom.
That could be it. $1 of GDP created by a software company consumes a tiny fraction of the oil that $1 of GDP from a manufacturing plant does. That would explain why oil is just shrugging off this seemingly bullish macro data.
Fascinating. So let's dive into the plumbing of the system. Section 4, the yield curve and financial conditions.
The bond market. What are the so-called smartest guys in the room thinking?
Let's check the levels. The 2-year Treasury yield is at 3.47%. The 10-year yield is at 4.09%.
Okay, so the 10-year is yielding more than the 2-year. The yield curve is upward sloping.
And the spread between them, the 10-year minus the 2-year, is positive 62 basis points, or 0.62%.
That's what we call a steepening yield curve. And historically, a steepening curve sends a very specific signal. It's the market saying the reflation trade is on.
Break down reflation trade for us.
It means the bond market believes that growth is coming back. And with that growth, a little bit of healthy inflation will return. It's a bet on economic expansion.
And who benefits the most in that environment?
Banks, the financials. Their business model is incredibly simple. They borrow money at short-term rates.
So around 3.47% today.
Right, and they lend that money out for long periods, like mortgages and business loans at long-term rates.
Around 4.09% plus their own markup.
Exactly. Their profit is that spread between the two. So a steep curve, or wide spread, is like a money printing machine for banks.
So connecting the dots, we have a 4.5% GDP print, we have a steepening curve. Bank stocks should be leading the market higher today.
They should be. But again, they're not. They're doing okay, but they're not on fire the way this setup would normally suggest.
Another contradiction. What's holding them back?
It's this weird conflict with the financial conditions data. Look at the NFCI, the National Financial Conditions Index. It's at negative 0.56.
And negative numbers mean conditions are loose.
Extremely loose. It's in the 7th percentile for the year. That means money is cheap, credit is flowing easily, and there's very little stress in the system.
Which should be another positive.
It should be. But I think the market has, for lack of a better term, PTSD from the last few years.
Post-traumatic stress disorder from the inflation fight.
Yes. It sees all the signs of a healthy, booming expansion, but it just can't bring itself to fully commit. It keeps waiting for the rug to be pulled out from under it.
Or it's looking at what the market is pricing in for the future. Look at the forward five-year inflation expectation.
The FWD 5Y.
Yeah, it's at 2.13%. That's the 9th percentile for the last year. It's incredibly low.
So that's the market's bet on what inflation will average 5 years from now. And it's basically saying inflation is dead and buried.
Right. So the market's view is we've got this weird growth boom right now, but long-term, inflation is not a problem. It's a very specific and maybe fragile narrative.
It feels almost too perfect. And when things look this perfect, the smart money usually starts making quiet moves under the surface.
Which is the perfect segue. Section 5, smart money and internal dynamics. What are the big fish doing?
We can get a read on this by tracking institutional flows. There's a source we watch that follows this, and it picked up a very interesting rotation that was happening just before today's data dump.
Okay, what was the move?
On January 30th, so just in the run-up, there was a clear trade. The smart money sold ASML.
ASML Holding, the Dutch company that makes the extreme ultraviolet lithography machines. Basically, they make the machines that make all the advanced computer chips.
They are the single most important company in the entire semiconductor hardware supply chain. If you are bullish on the AI hardware boom, you own ASML.
And they sold that. What do they buy instead?
They bought Microsoft and Workday.
Okay, so that's a very specific rotation. Selling hardware, buying software.
It's a classic rotation towards quality and safety within the tech sector. ASML is deeply cyclical. Its fortunes are tied to massive capital expenditure cycles from companies like Intel and TSMC.
It's a bet on the business cycle continuing to boom.
Right. If you're getting a little nervous, if you think maybe this 4.5% growth is a peak, not a trend, you sell the cyclical hardware names.
And you buy the subscription software names.
You buy Microsoft and Workday. You buy recurring revenue. Companies pay their Microsoft Office and Azure bills whether the economy is growing at 4% or 1%. It's sticky. It's predictable.
It's a defensive move, even within the tech sector, moving from cyclical growth to stable growth.
Precisely. They're high-grading their portfolio. They see the big GDP number and they say, that's great, but I'd rather own the reliable subscription revenue right now. I don't trust this boom to last.
And that connects directly back to what we said to watch this morning with the QQQ, the NASDAQ ETF.
It does. We said to watch for sensitivity, and what we're seeing is that the buying isn't broad-based. It's not buy all of tech. It's very selective. Smart money is picking its spots in software.
Which explains why the index is flat. It's not a rush for the exits, it's a churn. Money's just moving from one pocket of the index to another.
Exactly. Selling ASML pushes it down, buying Microsoft pulls it up. The net result is a flat line on your screen, but a massive rotation happening underneath.
Okay, so let's pull this all together and look forward to the rest of the day. Section 6, the watch list and the afternoon catalyst.
And we have a very, very weird catalyst today.
The weirdest. The unemployment rate for January.
Now, normally this is the main event on the first Friday of the month. It comes out at 8:30 a.m. Everyone gets their coffee, the number hits, the market goes wild, and you trade the aftermath.
But not today. Today, it is scheduled for 11 p.m. Eastern Time.
Tonight, on a Friday night.
Who does that?
Yeah.
It's just bizarre timing for arguably one of the most important economic data points there is.
I have no idea, but the timing is the entire story here. It creates a massive problem for anyone managing risk.
Because the markets will be closed.
The stock market is closed. The bond market is closed. You cannot react to this number in real time. If that print comes out at 11 p.m. and it's a huge shock.
Like if unemployment suddenly jumps to 6% or collapses to 2%.
If it surprises the market in a big way, like the GDP and inflation numbers did this morning, you are completely stuck with your position. You can't do anything until the futures markets creak open in Asia on Sunday evening.
That's what we call gap risk.
Massive gap risk. The market could open on Sunday 2 or 3% higher or lower than where it closes this afternoon, and there's nothing you can do about it.
So what does that mean for the next 3 hours of trading today?
It means nobody wants to be a hero. You're going to see position squaring.
Which means taking chips off the table.
Exactly. You flatten your book, you close out your risky bets. If you had a good week, you sell your winners and go to cash. You do not hold a huge leveraged position over a weekend with a catalyst like this hanging out there.
So we should expect volumes to trail off into the close.
I would, and I'd expect that defensive tone to continue. People will be hiding out, just trying to get to the weekend without taking on that gap risk.
Let's check in on the watch list we set this morning. We mentioned IWM, the small cap ETF.
Right, the Russell 2000. We said they're sensitive to growth. With a 4.5% GDP number, they should be flying.
And the Russell futures are currently up 0.07%.
So nothing, just like everything else. And that's really disappointing if you're a bull. That should have been rocket fuel for small caps.
It tells you the market is more worried about the rate-sensitive part of our regime than the growth part. Small companies get crushed by high interest rates.
Absolutely. Their debt is often floating rate. And what about TLT, the bond proxy?
The 10-year yield is holding at 4.09%. Real yields are neutral. The bond market is in a standoff. It sees the low inflation print, but it also sees the high growth print, and it's just waiting.
It's waiting for the tiebreaker, which is that 11 p.m. print tonight.
Okay, let's try to summarize this number soup for everyone listening. The regime call from this morning, macro-driven, absolutely stands.
100%. The data is the only game in town.
We got a Goldilocks data dump, shockingly high growth, shockingly low inflation, that the market is treating with extreme suspicion.
The trust gap is wide open. It seems too good to be true.
We have a historic currency shock with the euro up nearly 3.5%. That is causing chaos under the surface, but hasn't fully spilled over into stocks or commodities.
Not yet. That's the key word. A move that big takes days or weeks to ripple through the system.
And it's all happening in the shadow of this looming, bizarrely timed 11 p.m. unemployment number that is forcing traders to play defense into the weekend.
It's the calm before a potential late-night storm.
So if you're watching this, don't be fooled by the flat S&P 500. The real risks are hiding in other places.
They're in the currency crosses, and they are definitely in that gap risk for the Monday open. Don't underestimate that.
Before we go, I want to leave you with one final thought to chew on this weekend. We've talked all about these contradictions. 4.5% growth, 3.2% inflation.
The great divergence.
Is it possible that we've been so conditioned by the last few years of crisis that we've forgotten what good news looks like?
That's a really interesting question.
For 2 years, we have been in this bad news is good news world where we cheered for economic weakness because it meant the Fed might stop hiking rates.
We were actively rooting for a recession, yeah.
Today, we got unambiguous good news. Real, genuine good news. Growth is strong and price pressures are falling. And the market's reaction was to freeze like a deer in the headlights.
It literally did not know what to do.
But what if this isn't a one-off? What if this trend holds for another month or another quarter? At some point, does the market psychology flip back? Does good news become good news again?
That would be the biggest regime change of the decade. If we can get back to a world where strong growth is celebrated by the market instead of feared, that's when a real sustainable bull market can begin.
But first, we have to get through tonight.
We do, and we have to wonder if our definitions of volatility and standard deviation even apply anymore. When every day seems to have a black swan event, maybe none of them are.
Something to think about.
Yeah.
That's your midday update. Watch the close for that late day positioning ahead of the 11 p.m. print. Don't get caught offside.
That's your midday update. We'll see you before the bell tomorrow. Morgan, signing off.